Hello, this lecture presentation is on capital structure and financial leverage. I am Pat Obi, Professor of Finance at the Calumet campus of Purdue University. The learning objectives are summarized here. First is to define capital structure in a rigorous fashion. The second is to distinguish between financial risk and business risk, the two types of risks that are considered in the context of capital structure. The third is to explain the concepts of operating leverage and financial leverage. The fourth, to demonstrate the implications of earnings per share indifference level in a financing decision that calls either for the use of a more debt-laden type of financing or one that calls for a more equity-based financing. Number five is to describe the major capital structure theories, which I'm sure you learned quite a bit in your previous finance courses. And finally, to demonstrate the impact of changes in capital structure on the firm's cost of capital and therefore on the value of the firm. So we begin after going over the outline for the entire presentation with the capital structure question, which actually capital structure can be simply defined by the firm's debt ratio, which is the proportion of overall capital that is financed with debt. Keep in mind that total capital, as I note up here, is equal to the total amount of debts that you have plus equity. And if I may step down here real quick, I need to point out that for capital structure considerations and definitely for valuation purposes that the debt in this context excludes non-investor supplied liabilities, which are essentially accruals and accounts payables. Remember, accruals are simply expenses due but not yet paid, while payables are really trade credits. So back over here, if for example, the firm's debt ratio is 20%, then we know for sure that equity ratio would be 80%. Likewise, if debt ratio is say 40%, then equity ratio would be 60% because the two are complementary. Capital structure could also be described by the relationship between debt and equity in terms of the debt to equity ratio, because the debt to equity ratio, as you see here, simply tells us the amount of debt that you have per dollar of equity. For example, if the debt to equity ratio is 3, then it's telling us that for every dollar of equity that you have $3 of debt, meaning that the total capital equivalent there would be 4, which is $1 of equity plus $3 of debt to give us 4. And based on that, we can infer that the firm's debt ratio would be 3 out of 4 or 75%. And of course, in this sense, equity ratio would be 25%. Now, the key question in capital structure is, does a change in capital structure affect the value of the firm? Keep in mind, the goal of the firm is to maximize the value of the firm for its stockholders. So anything that affects value definitely calls for the attention of financial managers. So I illustrate this question in this form. Consider these two pie charts describing the capital structure situation of a firm in the before and after. Before is on my left and after is on my right. So before, this company's debt ratio is 40%. And this is given that its total capital is 100 million bucks. So that means that of this 100 million bucks here, 40 million is borrowed, the remaining 60 million is equity. Now it so happens that right now the firm's total value is equal to 200 million bucks. So the total value of the firm is equal to the total value of the firm's equity plus debt. So now this company is considering changing its capital structure from a debt ratio of 40 on the left to this after picture showing a debt ratio of 50. And of course, this change would have to be made without altering the firm's total capital, which is 100 million. So it's still going to remain 100 million. The only way, therefore, that this could be accomplished is if you were to go ahead and borrow some more money and then use the borrowed money to buy down, or if you like, buy back your equity. So by borrowing and buying back your equity, you are effectively increasing your debt ratio, in this example, from 40% to 50% and dropping down your equity ratio from 60% in the before to 50% in the after picture. But here's the deal. If you change your capital structure without altering the total capital, would the value of the firm, which currently is 200 million bucks, change? On the right side, would it change? And if it does, in which direction? Because if the market value of the firm would go up due to this change in capital structure, then the firm should be wise to pursue this change. If on the other hand, the firm value goes down or is expected to go down on account of this change in capital structure, then the firm would be wise not to pursue this capital structure change. So this is the question that is explored in capital structure theories as well as in capital structure practical considerations. Now, if I go to the next slide, I remind you that the total value of the firm is a function of projected free cash flows and the weighted average cost of capital. When the free cash flows are discounted, we obtain an estimate of what we believe to be the intrinsic value of the firm. Now, but our focus here is on the WACC, the weighted average cost of capital, which is the weighted average cost of debt and equity. WD here is the debt ratio. So if WD is 20%, then equity ratio, which is WE, would be 80%. If you were to change WD from 20% to, let's say, 60%, which of course would cause the equity ratio, WE, to become 40%. The question is, would WACC change in a way that will cause the value of the firm to change? Because remember, if you're going to change this debt ratio from, say, 20% to 60%, chances are cost of debt will change, RD. And if cost of debt changes, for example, if it were to go up, because investors are a little bit wary that a rise in the debt ratio spells an increased exposure to financial risk, which is really the risk of bankruptcy, then you can expect the required rate of return on equity to also change. So if the combined effects of these changes result in, for example, a higher WACC, then WACC being in the denominator because it's a discount rate would surely cause the value of the firm to go down, meaning that such a change would not be value maximizing. So the searchlight is really on the WACC, which if we know if it changes even for the same level of projected free cash flows, the value of the firm would also change. Before continuing, what we want to do in this beginning section is to address two issues that are a core aspect of the capital structure question, which is business risk and operating leverage. Now, the reason for this is because we do understand that financial risk, which is the risk of bankruptcy, is created whenever a firm borrows, and it increases, as I note here, the second bullet, with debt ratio. Now, what this implies is if a firm has no debt, then the firm is not going to have any risk of bankruptcy. If there are no debt type of financing for a firm, then there is no likelihood that the firm could ever go bankrupt. Bankruptcy is only of the essence if a firm borrows and then the fear that the firm may not earn enough to pay back debts, and the interest due on that debt would cause the bankruptcy question to become a relevant one. So without debt or any type of debt financing, then no financial risk exposure is indeed created for the firm. But regardless, all firms have a business risk, which are the general risk factors that a business faces. Some of them may be internal, some may be external. Examples of external risk factors would include financial crises, economic recessions, and in fact, competition with other firms in the same industry. Internal risk factors would include labor problems, corporate fraud, product and pricing problems, and operating leverage. And you say operating leverage? Well, I explained here that operating leverage, which is a type of business risk, is a measure of fixed operating costs in a firm's overall cost structure. Now, keep in mind, in running a firm, some of the operating costs are going to be fixed, like depreciation expenses, maintenance, insurance, those types of costs usually are invariant to changes in sales. On the other hand, some costs are variable. A typical one are wages. So now we note here that operating leverage would be said to be high if a high percentage of the overall operating cost in a firm is fixed, meaning that fixed operating costs are high relative to variable costs. So think of the airline companies that have this huge fleet of planes that they have to depreciate, maintain, they have to be insured and stuff like that. So such firms have a high degree of operating leverage. On the other hand, retail firms really and restaurant firms don't quite have such a huge amount of fixed costs, and so a great deal of their operating costs are going to be variable. Now, degree of operating leverage, well, it is really a measure of business risk, as I noted earlier, and it calculates the percentage change in operating income, which can be defined by the firm's earnings before interest and taxes, on account of a change in sales. So the degree of operating leverage, because it's a measure of the sensitivity to operating income to changes in sales, it serves as a risk measure in that the higher the percentage of fixed operating costs within a firm's overall cost structure, the greater would be the degree of operating leverage. Therefore, meaning that any change in revenues in sales would bring about a more than proportional change in the firm's operating income. So the DOL number is a type of measure of elasticity. If it is high and if a small change occurs in the firm's revenues, we're going to see a more than proportionate change in the firm's operating income. So actually, in this slide here, there are three issues that are reflected. The first is if you have a high, if the proportion of your operating cost is high, then you're going to have a high operating leverage. That's number one. Number two is because you have a high degree of operating leverage, then it means that a small change in sales would lead to a high change in your operating income. The third one is this means that degree of operating leverage is a measure of risk, because the higher it is for a firm, then the greater would be the negative impact that a change in sales would have on your operating income. So look out for firms whose operating leverage is very high. Again, like the airline industries, the steel industries, and all these firms in capital intensive industries. These firms, they suffer quite a bit when the economy is weak because their costs remain, for the most part, unchanged. They do not go down with their revenues, and therefore these firms tend to be more hurt by adverse economic conditions. The degree of operating leverage is summarized here, defined by the percentage change in your operating income measured by your EBIT with respect to percentage change in sales. It is so calculated, sales minus variable cost. This numerator is actually your contribution margin. And then this is divided by sales minus variable cost minus fixed cost. This denominator is actually your earnings before interest and taxes. So essentially, by dividing your contribution margin by your EBIT, you get your DOL. So what does that mean again? Well, consider this. Suppose DOL is equal to 1.4. And then let's say that your sales drop by 10%, as I show here. This means that your EBIT, which is your middle line on your income statement, as I'll show shortly, is going to fall by 14%. How do we get that? Well, it'll be your degree of operating leverage. Remember, I said it's a measure of elasticity multiplied by 10%, the change in sales. So 1.4 times 10 will give you 14. So for example, again, if your DOL is say 2, then it means if your sales are expected to fall by 10%, your EBIT would fall twice as much, which is DOL of 2 times 10, which is 20% drop in EBIT. So as you can see, the higher your your DOL, the greater would be the negative impact that a fall in sales would have on your earnings before interest and taxes. Look at this example right here. This company's revenues currently amount to 700,000. Variable cost is 350, so that already gives us a contribution margin of 350, which is the numerator of the DOL measure. And then if you subtract your fixed costs of $100,000, then you come down with your EBIT, your middle line, as I call it, of 250. So this 250 is the denominator, your sales minus variable costs minus fixed costs. That's how you get your 1.4 right here. So your top line and your middle line. And the deal here is, how would your middle line, your EBIT here, change for any given change in your sales? So let's say that sales are expected to go down by 10%. Well, we already know that based on your current data, your DOL is 1.4. So if you tell me that sales would go down by 10%, I know right away that your EBIT, your middle line, is going to go down 1.4 times as much, which is 14%. Well, it turns out that if in fact you evaluate this, dropping sales from 700 to 630, which is a 10% drop, and of course your variable cost dropping by the same rate, and your fixed cost staying fixed, which is what it is, you will find that your EBIT would drop from 250,000 to 215,000, which is a 14% drop. So it works out even after the fact. And the reason we know how this will pan out is because we knew what your degree of operating leverage was starting out. Likewise, if sales are expected to go up by 10%, we know that your EBIT would go up by 10%, which is from 250,000 to 285,000. So once again, if this number DOL were higher than it is, you would observe that the decline in EBIT would be even more drastic. And that's the fear factor. So to summarize, firms with a high degree of high fixed operating costs have a high break-even level, as we know from our study of cost volume profit analysis, aka break-even analysis. And such firms therefore would have a high degree of operating leverage. So if your fixed operating costs are pretty high, then you're going to have to work a little harder to break even. And that in turn means that your degree of operating leverage is going to be pretty high. With a high degree of operating leverage, we summarize here, a small decline in sales, which are your revenues, would cause a more than proportionate decline in your operating income measured by your EBIT. So the pictures that you're familiar with are shown here again. On the left is the break-even point illustration for a firm with a lower level of fixed costs than this firm on the right side, whose fixed operating costs are almost 1.5 times as high as the guy on the left side. So now pictorially, you can observe that this break-even point is going to be a little higher than this one right here on the left. So the guy on my right side here, this firm on the right side, is going to have a higher degree of operating leverage because we know that its break-even point is higher. So, and as a result, a small decline in revenues would bring about a more than proportionate decline in the firm's this firm on the right side in its EBIT, more so than the guy on the left side. And I show you here an example of how you learn to calculate your break-even quantity, which is the ratio of your fixed operating cost to the difference between your price per unit and variable cost per unit, your contribution margin, that is. So if you plug in these numbers I place here, you'll find your break-even quantity to be 40. That means this firm had better produce no less than 40 if it wants to remain profitable, produce and sell for that matter. So anything less than 40 isn't good. You'd be in the negative territory of profits. Anything above 40 is good because you will be smiling with some cash in your stash right there. So, and of course, with break-even quantity of 40, you can also find what it is in dollars. Simply multiply 40 by the price per unit, and you'll get the dollar amount representing your break-even in dollars. All right, that wraps up this first segment of the presentation. And next up, you're going to learn about financial leverage a little bit more.